Okay, good morning or good afternoon, everybody, wherever you may be. My name is Anthony Price. I'm the current chair of the SEG European Regional Advisory Committee, which was developed to help represent and serve the SEG members here in Europe. And today we have another one in our series of the State of the Geophysical Industry talks. And I'll hand over to Laurie, who will introduce today's speaker. Thank you, Laurie.
Yep, thank you. Yeah, today's speaker is Kristian Johansen. He has served as the Chief Executive Officer of TGS since March of 2016. He joined TGS in 2010 as a Chief Financial Officer before becoming the Chief Operating Officer in early 2015. Kristian has almost 20 years of C-suite level experience for public companies in the construction technology and energy industries. Mr. Johansen has professional experience from board positions of several public companies in Europe and the United States and industry associations such as the National Ocean Industries Association and Energeo Alliance. Currently, he is a non-executive director of two U.S. public companies, Belarus and International Seaways. Mr. Johansen earned his undergraduate and master's degree in business administration from the University of New Mexico. And today we welcome him to this wonderful webinar that the European Regional Advisory Committee will offer you all. Thank you, Kristian.
Thank you, Laurie, and thank you, Anthony, and thank you everyone for joining us this morning. I was just thinking back, and we talked about it before you all joined, that I did this back in 2018. I had a similar presentation. Obviously, my slides are very different this time because the industry is different. You know, when I think back to 2018, I mean, we were actually coming out of a pretty tough period from 2015 or 16, and things were getting gradually better. And I think 2019 was actually a pretty good year for the industry. And then obviously we were all hit by COVID in 2020, and then things have been a little bit out of balance ever since then. I'm going to pull up my slides and share my slides. I will be talking to you for about 20 or 25 minutes. I would really appreciate if we could have questions from you guys. So I'm sure you know the drill in terms of posting your questions. Trying to pull up my slides here.
Yeah, we see them.
Great. Yep.
Should be able to see the slides now.
Yes.
And you see them in presentation mode?
Yes, they're perfect. Yep.
Very good. Thank you very much. So what I'm going to be talking about today is, my first topic is what I call change priorities in the E&P industry. And this goes back to what I talked about that last time we spoke in 2018, things were getting better. But in fact, if we look back on the E&P industry, there is a pre and post 2015. And I'm going to talk about that pre and post period and how that has impacted the geophysical industry. Switching from that, the next topic is on seismic industry consolidating and the supply side tightening. And this is basically an adaptation to what happens in the E&P industry. As the E&P industry changes its priorities, the seismic industry had to adapt to that. And you will see a few slides on how we have been able to cope with that. And then I'm going to touch on what I call mature basins require evolving technologies. This is kind of the positive news about all this, is that there is still a need for data. There is a big push for better data. And as a result of that, we've seen a lot of technology developments, both on the OBN side, but also on the imaging side. And then last but not least, which is also good news for our industry, is that the energy transition drives new data needs. I think we as an industry have realized that these energy transition related industries also need a lot of subsurface data. They don't have the same knowledge as we have in oil and gas and that we have developed from gas. And there will be a significant need for our products and services and people, for that sake, also in the energy transition related industries for the future. So that's a kind of flipping through what I'm going to be discussing today. Again, my first topic is on the E&P industry and how that has changed. And on the first slide here, I just want you to focus on the two boxes rather than the blue or dark blue and light blue line. And I'm going to come back to those lines. But if you look at the key characteristics of the E&P industry in the period up to 2015, and particularly from where the graph starts here in 2003, the key value drivers were growth. It was all about growing their portfolios, growing their reserves, and investing for the future to make sure that we can continue to supply the world with more energy. And companies typically took a very long-term view on that, and the shareholders appreciated that and supported that type of strategy. The way they measured themselves were on what we call triple Rs, so reserve replacement ratios, meaning that if you produce 100, you need to find more than 100 in terms of continuing to grow your portfolio and reserves. And then the exploration focus as a result was about 70% of exploration in 2013 was in frontier basins. So a lot of frontier exploration, which obviously we as an industry benefited from because that's where we're good. We're good at acquiring new data in new places. And obviously this was needed for our customer base. And then if you look at the number of active companies operating in this field, and now I'm talking on the E&P side, it was a high number. It was if you go back to the lease sales in the US Gulf of Mexico as an example, in the period up to 2010, there were about 85 companies participating. So a lot of smaller players, obviously all the big players were there, and a very fragmented customer base on a global basis. And then there's a dotted line there in 2015, and you see a significant change in priorities. So rather than focusing on growth, our clients or the E&P companies were now focusing what we call return on capital and cash flow. And that's been like that ever since. Companies are being rewarded by their shareholders to pay a dividend. And in order to pay a dividend, you shouldn't invest all your money in growth. You should allocate some of that funds back to your shareholders. The second thing we see is that rather than focusing on triple Rs and reserve replacement ratio, the focus was now switched to cost and cycle time. So it was all about, you need to reduce your cost, you need to improve your efficiency, and the time to first oil has to be reduced substantially. And the reason for that is obviously that at the time, and particularly in the period after COVID, all companies haven't been sure about how long do we actually need our products. Is peak oil going to be in 2027? Then we don't need to worry too much about reserve replacement ratio. We need to worry about cycle time, and we need to get that cycle time down. When the best example of that is probably Exxon in Guyana that went from discovery to first oil in less than 5 years. And that's a substantial improvement to what you've seen back in the period pre-2015, where it could take as much as 10 or 12 years to get there. And then if you look at the next one in terms of exploration focus then switched. As you remember, I said a couple of minutes ago, back in 2013, 70% of exploration spending went to frontier. Now in the period after 2015, we see only 30% of exploration activity going to frontier, and the other part of the budgets go to what we call ILX, or infrastructure-led exploration, which means that the two flipped. And as a result, our industry, it's not like it wasn't needed anymore, but obviously all the frontier efforts that we did, particularly all the multi-client investments we did in frontier areas, were now switched into what we call mature areas or infrastructure-led exploration, which has a very different characteristics because now you're looking for oil in places where oil already has been found. And it doesn't mean that seismic is not important. Seismic is still very critical, but it means that you need a different type of seismic. You need to go very high end because you need to provide your clients with data that is better than what has already been shot. And this is the reason why you've seen a bit of a shift from obviously 2D seismic to 3D seismic, and then to ocean bottom nodes. And then the number of active players on the E&P side, so on the client side of the geophysical industry, you see it's lower, and it's substantially lower, and it's partly driven by some companies basically running out of business, and also some companies being acquired. So you've seen a peak in terms of M&A activity, for example, in 2023, because all companies need reserves, and they realize they need reserves, but exploration takes too long. So it's better to just buy a company who's already done the exploration for them. So that's kind of the backdrop of how this industry has changed. And then I want to turn the focus to the dark blue and the light blue lines on the graph. And what you see here, if you go back to 2013 or 2014, is that the light blue line is at the level, and this is the y-axis to the right, is at about 110 to 120. So this is where the oil price Brent was in that period from 2011 to 2014. You see the line is relatively steady between 100 and 120. But at the same time, you see the dark blue line is going sharply down, and it's going down before the light blue, which means that the return that the oil companies are making is falling despite the fact that the oil price is very high. And we all know how that is. You know, if we're rich and we feel like we have a lot, we spend more, and we probably don't look twice on every purchase we make. And that's kind of what happened with our clients too. They built up an enormous cost base, and they got less and less competitive based on that higher oil price that they could afford when the oil price was 120. But if the oil price started to drop, which it did in 2014 and 15, you see that the dark blue line goes below zero, which means that the return on investments for an oil company is below zero. And if you can get 5% interest in the bank, you would never buy an oil company stock or equity for a return of less than zero. I mean, it's quite obvious. So they had to do something, and that's really what they did, is covered in that box to the right, where we talk about the shift in focus from reserve replacement ratios and growth, and we shift the focus to an intense focus on cost, cycle time, and what we call return on capital. And return on capital, as I said, if the return on capital is below 5 or 10%, which you would usually see in either a bank account, or you see that type of interest in a mutual fund, so that's kind of what you're competing about. So our clients and we as an industry need to target approximately 10% return on our investments for those investments to make sense. So this is really the backdrop of what happened and what we've seen since last time we met in 2018. And you see after 2018, you see a sharp drop in both the oil price, but also in the returns that went below zero, or significantly below zero, of course, in 2020. And then we as an industry who work with these E&P players and service them and license or sell products to them obviously need to change as well. But let's have a look on the next slide in terms of what happened further with our customers. So obviously it has an impact. If you turn the focus from growth to value and you invest less in your future, then it's going to hurt somewhere. And this is where it typically starts to hurt. So the reserve life of the major IOCs. So basically, if they stop exploring today, how long can they be producing oil and gas at today's production level? Well, what this shows is that for oil, that has dropped from 13 years back in 2013 and down to about 9 years in 2023. So in the matter of 9 years, it's dropped by 4 years. So then you can do the math yourself. So in another 10 years, it's going to drop by another 4. And then eventually we will run out of gas, oil and gas. Or in this particular example, the IOCs, which are the 8 or 9 major oil companies in the world, will run out of oil and gas. So obviously that's not a sustainable situation. We all know that we will need oil and gas for many decades to come. So this is the graph that they're all looking at, and they're trying to balance, how much focus are we going to have on growth and reserve life, and how much focus should there be on dividend, share buybacks, and making sure that our current shareholders are pleased with our performance. So again, you see the graph is kind of downward trending for oil, same for gas, although 2023 was slightly better. But the long-term trend is definitely that we reduce the reserve life pretty much every year. And we typically reduce it by somewhere between 50 and 75% every year. And then if you look at the next slide, I've called it exploration takes too much time, let's buy reserves. And you clearly see that if you look on the left-hand side here, you see exploration spending. And again, we're looking at the same. We're looking at pre-2015 and post-2015, and you see a completely different world. 2011 to 2013, record high investments in exploration. Again, this didn't really pay off. Exploration success was not great in that period, so we need to get better at exploration. But we probably cannot cut it as much as our clients have done in the pre and post 2015 period. So you see it drop down basically to a new level in the period of 2016 to 2018, and then we dropped again in after COVID, and we've seen a slight improvement, but in my opinion, it would not be sustainable for the future. So what did they do then? Well, they went to buy companies instead of doing exploration. As I said, you know, the time to first oil may be 5 to 10 years. But if you buy a company who already has exploration, then it takes zero, right? It improves your reserve replacement ratio. It improves your average reserve life immediately. And that's what you've seen. And that's what you see on the right-hand side, where 2023 is the highest year ever in terms of M&A transactions or merger and acquisitions in the E&P industry. And obviously, you've seen all these mergers taking place. You have Woodside, BGP, you have Harbour Wintershall, you have the Chevron Hess. I mean, there's numerous big transactions in the E&P industry, and they're all driven by the same story as I've been through on these 3 slides. So that was kind of the backdrop and what I wanted to discuss in terms of why is it the way it is, and why have we seen the changes we've seen in the, as I said, pre and post 2015 period. So let's have a look at how that has impacted the seismic industry, because obviously we are very dependent on our clients. The fact that the clients are being, you know, fewer, or the fact that the client base is consolidating, the fact that they change the priorities obviously has a huge impact on us or the geophysical industry as a whole. So this one is showing TGS only, but I could obviously have added a few other companies to this. But these are all the companies that are today owned or controlled by TGS. And if we go back to 2013, TGS made an acquisition of an onshore seismic company in Canada called Arcis. In 2015, we bought the database of Polarcus, who went into bankruptcy at a later time. We did the same thing with Dolphin in 2017. We also did a company called Multi-Client Geophysical. We did Seabird Exploration. And again, we bought the databases, not the corporations. So these are all data purchases. Spectrum in 2019, and if you look at the lower line there, you see that Spectrum had already acquired the seismic business of Fugro, or the data library of Fugro, back in 2015, and also CGG's 2D data library in 2011. So when TGS acquired Spectrum, we also got the database of Fugro and CGG as part of that, or CGG's 2D database. And then it continues in 2021. As I said, the industry changed dramatically in terms of the focus on oil and gas versus renewables. So there was a great push on the industry in terms of you need to get into renewables because oil and gas may not be here in 10 or 20 years. And as a result, TGS made 2 acquisitions in renewables, a company called 4C Offshore that is doing market intelligence for offshore wind, and a company called Predictor that is doing asset management software and solutions to the solar sector. In 2022, ION went into Chapter 11, and TGS picked up the data library and the processing business of ION. In 2023, we acquired a company called Magseis Fairfield that used to be Fairfield that Magseis merged with, and then basically TGS took over both these companies, and then in 2024, PGS. So this is not a corporate pitch where I'm trying to say that TGS has been unique and we've been consolidating in an excellent way and that kind of stuff. What it is to show the significant consolidation this industry has been through. And I'm sure there's a lot of people here on the call who have been part of some of these companies or even quite a few of these companies in the past. And these companies are all part of TGS today. And then the second slide I could have shown you is Shearwater, because Shearwater has done the same thing on the vessel side of the business. So Shearwater was established based on the bankruptcy of Dolphin. And since then, they have acquired vessels or vessel businesses from both WesternGeco, CGG, and also a few vessels from Polarcus. So there's been a substantial change in company strategies, again, post and pre-2015. And there's been a change in terms of the number of players who make up this geophysical industry, which I don't think any industry within oil services have ever seen before. There's not a single part of the oil service industry so consolidated as the seismic sector is right now, and particularly in the vessel side of the business, which I will show you in a second. And here you see the number of active global vessels, and these are 3D vessels. And we go back and see that 2013 was kind of a peak for this industry. You had 7 different companies who owned vessels, and they owned quite a few vessels, and there was no major player. There were actually quite a fragmented picture in terms of 4 or 5 players who owned more than 5 vessels. And then you see a gradual decline, and this goes back to the consolidation story that I just went through a minute ago with Shearwater. And what you see is that if you look at the far right end of the bar chart, you see that there's basically 2 players left. It's the new TGS, which is obviously the combination of TGS and PGS, and it's Shearwater. And then there's a couple of vessels that has different ownership or is not controlled by those 2 companies. But as you see, they're very, very few. So basically, this market has gone from 7 players to 2 players in the matter of just a few years. And again, we're going back to the initial story I made. It's a pre-2015 and post-2015 story that plays out here for the geophysical industry. And then we go to the next slide, and the next slide talks about the OBN market. Because even if the number of vessels have dropped from more than 60 to about 15 to 18, it doesn't mean that there is no demand for geophysical services. So what we've seen is a shift or a gradual shift from streamer seismic to ocean bottom node. And what you see here is a fantastic or a phenomenal growth story where you've seen OBN has managed to grow significantly despite being a business that is mainly exposed to the post-2015. So again, the picture is not as dramatic as I showed on the previous slide because some of this activity has been shifted from streamer seismic to OBN. And this is particularly true for 4D seismic, where 4D seismic in OBN business that represents about 90% of all the OBN contracts are 4D, while for 3D streamer seismic, that number is somewhere between 30 and 40%. So again, a significant shift. And a second thing that you see from this slide is that there's actually quite a few players in the OBN market. There's TGS is obviously a major player in that area. Shearwater is quite significant as well. And then you have a lot of smaller or mid-sized players who's taking advantage of the fact that the OBN market is still growing despite being a business that is mainly exposed to the post-2015 area of the geophysical industry. So that, again, I started with how the E&P industry has changed, and then my second chapter was on how the geophysical industry has changed as a result of the changes on the client side. And then next, we're going to look at a third topic, which is about mature basins require evolving technologies. And what I'm going to show you here is first of all, a slide that most of you have probably seen before. This is Chevron has been showing this. It's originally made by Woodmac, and then TGS has also continued to add data to this chart. And what it basically shows is how the technology development has been evolving since the early or late 70s to early 80s, where obviously all we did was 2D seismic. Then we changed from 2D to 3D. And then you see all the different technologies who have been used to find new plays in the period from 1980 to 2024. And this continues, and there is an evolving technology development in the seismic space. And of course, this is the future for not only TGS, but for all the other companies in this space, is that we need to make sure that we provide our clients with the latest and greatest technology, and making sure that we can find oil more efficiently in places where oil has already been found. And you obviously see FWI here. You see, what you don't see is elastic FWI, which is the hottest topic right now. You see this chart ends with sparse node acquisition, which we've seen for about 5 years now. And now when you combine the sparse node acquisition with elastic FWI, you get the greatest and best pictures. And I'm showing Gulf of Mexico as an example because it's probably the best or the most mature basin, which has seen seismic acquisition for the longest time. But what it shows is that you can keep a basin alive by basically reacquiring or overshooting your existing data as new technologies evolve. And this is a great way to show that. And we will see similar things in Brazil. We will see similar things on both sides of the Atlantic margin, of course, as the area or the basins are getting more mature. And as a result of that, we've seen the OBN market change quite substantially. As we see more ILX and more 4D, we also see a higher number of OBN surveys, and we see that the geographical expansion of the OBN market, where you go back and you look at the map on the left-hand side, you see that the majority of activity was in either US Gulf of Mexico or the North Sea. And then you see today it's quite a global market, where you see obviously a lot of activity in Latin America, South America, West Africa, and obviously US Gulf of Mexico and North Sea continuing to be the dominant market. But again, this is a great example of how new technologies have driven the need for geographical expansion, and you see our clients are demanding higher end data in areas where they may only have 2D or 3D from before. We see that it starts with 4D, but eventually this will be a tool also used for exploration, as we're using it in the Gulf of Mexico today, and as we've been doing now for the past 5 or 6 years. All right, we're getting to the end of the presentation. I'm going to talk a little bit about the energy transition and how that drives new data needs. And I think you've all seen how offshore wind, for example, has been a great driver of subsurface data. They don't need the same type of quality subsurface data. We're obviously looking shallower, but we still need subsurface data in terms of these big offshore wind installation. And obviously what we haven't seen a lot of yet, but which we will see in the future, is a lot of subsurface data acquisition and monitoring related to big CCS programs, which in my opinion is going to be the license to operate in decades from now. You will see more and more CCS, and you see big companies like Exxon, for example, investing heavily into CCS because they know that they will be producing oil and gas in 20 or 30 years. But in order to do so, you need to produce in a cleaner way. You need to lower your emissions. And the way to do that is most likely through CCS. This picture just shows how TGS has been getting into this market. We're doing this very similar to seismic. We start with intelligence and screening. Again, this goes back to the acquisition we made of this company 4C Offshore, which is really providing market intelligence. And it's a company that is sort of similar to a Rystad Energy or Woodmac for offshore wind. So rather than oil and gas, we focus on offshore wind. But then the key part here is new data acquisition. And what you see here are, assets that are quite familiar. On the right-hand side, you see our Ramform vessels acquiring data for offshore wind. So we call it the ultra high resolution data. And then you also see some pictures on the left-hand side, which may be less familiar to you. So in the upper left-hand corner, you see what we call a LiDAR buoy. A LiDAR buoy is basically an asset that we put out in the ocean, and we measure wind and ocean metadata. So basically, we put it out there for about a year, and then we can license this data to an offshore wind company, and they will know, all the characteristics of that area, and they would know how to bid, whether they want to bid, and obviously what the economics of that offshore wind investment will be. So very similar to what we do in seismic. We go out and we collect data, and then we license data to multiple parties, either before a lease sale or after the lease sale when the leases have already been awarded. And then where we want to get at the end is obviously we want to provide knowledge. It's not only data, it's also providing knowledge to our clients. And then why do we do this? Well, we do this because we see a tremendous growth in particularly offshore wind, but also in solar for the future. I think we can agree that there will be oil and gas in many decades from now. And if you look at the forecast from whether it's IEA or it's Exxon or whoever it is, you will see that they still believe that the production of oil and gas, or the supply of oil and gas, even in a few decades from today, will be pretty much around 100 million barrels. So we will still be at a very steady level of about 100 to 105 million barrels. But the rest of demand, because demand is continuing to grow, the rest of it will have to be covered by new energy sources, and offshore wind is obviously one of them. And as a result, you see the line that is related to offshore wind is growing sharply. It started to grow already, but it's going to grow at an exponential impact over the next few decades. So that was what I planned to go through today. I will give you a brief summary. We've covered the change of priorities in the E&P industry. We've seen, as a result, the seismic industry has been consolidating. We see a supply side that is very tight with only 2 players on the vessel side. We see mature basins require evolving technologies, and that's driven the need for better technologies on the OBN side and also on the imaging side. Energy transition driving new data needs. Again, the fastest growing segment of energy now is offshore wind and solar, and we as an industry can take advantage of that. And last but not least, spending will have to increase. What's going on right now, where all companies focus most of their capital reserves on dividend and share buybacks, it's not sustainable for the future. And I think we see that on the right-hand side, where we see the supply of oil and gas historically, and then we see the estimates for the future, and we see a big white space there, and that white space is what needs to be covered by exploration in the future. So while there may not be urgency, the reserve life is still 9 years, we're getting closer and closer to a time where all companies need to change their investment profile, and although probably not go back to the pre-2015, they need to find a balance between pre and post 2015. So that's all I had in terms of slides. I want to thank you for your attention, and again, pass it back to the facilitators, and happy to take your questions, of course.
Thank you very much, Kristian. That was a wonderful overview with a good deal of insight and backed up with a lot of experience you must have. Can I remind everybody that to ask your questions, please type them into the Q&A box, not the chat. The Q&A box is the one we'll be watching to read out your questions and pose them to Kristian. So with that, we have one in there. I was pretty anxious to ask my question first, so I dropped it in there, and I'll ask it myself if I can. Perhaps you already touched on this point, Kristian, but and I sort of already know the answer, but I'd like to hear your take on what happened in 2015 to change the industry so dramatically. I mean, what was the driving force or the cause behind that vast change in attitude for a lot of the companies in the global industry?
Yeah, I think what happened is that the return on capital dropped below zero, and it dropped below zero as a result of a significant oil price drop, but also the fact that the oil price dropped at the same time as the cost base of the E&Ps were too high, and obviously not a good combination, which means that the return was below zero. And if the return is below zero, no shareholders want to hold that stock. They sold out, and there was sort of a crisis among the E&Ps in terms of what do we do in terms of making ourselves attractive again for the equity markets. And that's really where it all started, and they had to cut their costs substantially. And yeah.
And I had speculated that the shale and oil and gas revolution in the US onshore was ramping up at about that time. Might that have had something to do with it?
Absolutely. At the same time, obviously, a lot of companies shifted their focus to onshore. We saw a significant production increase on the onshore side. We saw onshore having a great advantage compared to offshore in terms of time to new oil. Its cycle time is obviously substantially shorter. So again, offshore was kind of the one who took the beating from that.
Okay, thank you, Kristian. We have a question here from Andrew Lewis asking M&A or mergers and acquisition is relatively expensive, and it's a challenge for E&P companies to produce the market type curves. At what point do they pivot back to exploration for new reserves?
Yeah, I think, M&A, what these companies typically do is that they don't pay cash for their acquisition target. They typically pay with shares. And if the acquirer's share price is high and the target share price is high, it doesn't really matter, right? Because you pay with the same type of currency. You pay with an inflated currency. So that's typically what happens, is that they keep on buying companies using their own share price and their own stock as a currency. So in that regard, even if it's expensive, they seem to be able to afford that, and they can justify it from cost synergies and you name it. But I mean, you're going to get to a point where there's not a lot of targets out there, right? You've seen a lot of the mid-sized players in the world basically disappear, and a lot of the targets are already taken. And there will be a time, of course, where companies need to reevaluate this strategy, and it may be, as you said, too expensive to do M&A, or the target may not be there, and as a result, you will have to do more exploration. And we've seen early signs of exploration coming back, and we see some of the super majors are definitely going back to exploration. But again, we're very, very far off from where we were back in, again, pre-2015, as I talked about.
Excellent. Thank you, Kristian.
I have a few questions in the chat, so I will start at the top. The first question, how do you see emergent countries like Brazil for seismic technologies and R&D cooperation?
Yeah, I mean, the short story is that Brazil is probably one of the most attractive countries to invest, not only for E&Ps, but also for the geophysical industry. And it's due to so many different reasons. Number one, it's a relatively challenging environment, so you need good data and you need good technologies in terms of being competitive in Brazil. Second one is Petrobras is investing into this, and Petrobras is definitely one of the companies who are quite vocal about the fact that oil and gas will be needed in many decades to come. And Petrobras is a very, what I would call advanced technology company. They are investing a lot in technology. They're investing in geophysical companies who want to develop new technologies and take a very long-term view and a very partnership approach in that regard. So I think, you know, Brazil is definitely one of the countries where I would put on the top 3 list in terms of future prospects for sure.
Nice, thank you. The next question, how do you see the role of the national oil companies or partnerships with those national oil companies in filling the white space?
It's going to be increasingly important, and we've seen NOCs going out of their home markets or domestic markets, which is good. We see Petrobras being more of an international player. We see Petronas doing the same thing. There's a long list of NOCs now going internationally in their exploration efforts, and of course, you know, the IOCs or the super majors, they typically will have to work with the NOCs when they want to enter the NOC domestically. But likewise, when the NOCs go out internationally, they typically will have to partner again with the IOCs. So it's kind of a win-win for both parties, and you will see that NOCs play a bigger and more important role in the future of this industry for sure. And also they have a tendency to look very long-term, and they typically not listed on the stock exchange and have to focus on the next quarter, but they can focus on the next decade, which obviously helps them in terms of setting their long-term plans and being consistent.
Thank you. The next question wants to know, how does TGS see the market for UHRS in the offshore wind sector?
It's developing relatively rapidly. I think we've probably seen a little bit of a setback here in the US, given the new administration stance on offshore wind. But I think in Europe and elsewhere, we see significant growth, and we're just scratching the surface now. I think our clients are realizing that this is needed. They're realizing that they don't have the right data, or they didn't have the right data before, and they understand that this is a step change in terms of their efforts to bid for new licenses and develop new offshore wind areas.
All right, thank you. The next question, the number of potential clients and the area of 3D acquired has halved or cut itself in half since 2015. Margins are low in renewables, so there's been a movement back to oil hydrocarbons. And the question is, after all that, where will revenue for seismic companies come from in the future? Will oil companies pay for high quality elastic FWI imaging over mature areas?
Yeah, I'd say, you know, I'm probably more on the optimistic side in terms of the future of this industry, because as I said, I don't think it's sustainable what we see today. So I think our oil and gas companies have to explore more. And I think there's no substitute to seismic or subsurface data. And they're not going to do it themselves. So obviously we as an industry will continue to have decades of activity, no question about that. But I think what makes me even more optimistic is that at the same time as all companies will have to explore more, you will see offshore wind activity, you will see CCS activity, and there's going to be a lot of different drivers happening at the same time, which means that this industry will eventually be a good place to be. But it's going to continue to be volatile, it's going to continue to be cyclical. But I think for most of you are on this call, I think you've experienced that for decades, and it's just something we need to get used to. And yeah.
All right, thanks. Anthony, do you have additional questions in the Q&A, or should I continue with the chat questions?
No, please continue with the chat questions. I'll handle the Q&A ones when you're done.
All right, wonderful. The next question is, what comes next after elastic FWI?
Yeah, I'm probably not the right person to answer that. And even if I knew the answer, I probably couldn't tell you, because this is obviously our biggest secret in terms of what we're trying to do next. I think we're still in the relatively early days of elastic, and I think there are still companies trying to play a little bit of a catch-up game and get more efficient and get better in that space. I think this is obviously the hot topic right now within the imaging world. And again, I'm not going to sit here and guess what the next technology is going to be. I'm sure there are other people here on the line that knows far more than I do on that.
All right. The next question says, looking at your graph on active streamer vessels, it seems like it has been around 20 plus over the last 4 or 5 years. Was this limited by availability of vessels or by demand? And how do you see this trend changing in the coming years?
Yeah, it's probably limited mainly by demand, because the right number is probably around 17, so 17 active vessels, and there are still vessels that you can take out of warm or cold stacking. So if demand was higher, you can probably get up to 22, I guess. But if demand is going higher than 22, it's going to get tight. And again, that's what I'm saying. Eventually you will see demand pick up in oil and gas, but at the same time you will see demand pick up for CCS and offshore wind, etc. So that's a point where 22 may not be enough, and as a result you will see some companies having to wait for availability, and obviously pricing will probably go up as a result of that.
Right. I guess the last question in the chat that I see, cost-wise, how does conventional land versus ocean oil production compare with shale oil gas, which will be the long-term trend?
Yeah, I think for shale oil, if you look at the Permian, for example, most people would say that the Permian is going to be quite active down to about 60 for West Texas. And if it drops below 60, you're probably going to have you're going to see lower supply, which again is going to drive the oil price up again, right? So I think that's what we've seen in previous cycles. I think there's a lot of offshore basins that are cheaper, where the cost is lower. So the best offshore areas are certainly more competitive. But I think where onshore has a great advantage is, as I said, the time to first oil. It goes so quickly, and obviously you will still see significant activity, particularly in the lower 48. But saying that, I mean, this is a $1,000 question right now. Trump wants a lower oil price, but at the same time he wants higher production in the U.S. Well, you're not going to get higher production if the oil price is too low. Then you're actually going to get lower production. So finding that equilibrium point is really the magic right now. How can we do that? Personally, I think based on TGS data that we've collected in the lower 48 for 30 years, I find it hard to see that you're going to have significant growth. It's probably going to be flattish at best, and the reason for that is that a lot of the easy oil has been found, and we've tapped into the most prolific areas already. So it's not a huge potential in that regard.
All right, thank you. Anthony, I will let you handle the Q&A.
Sure, thank you, Laurie. There are still a few questions in the Q&A. One here is a fairly direct question about TGS itself. How do you see the offshore workforce changing for TGS? Are you using more contractors these days?
I think we have a good balance of contractors and own employees, and it's a discussion we have quite regularly. It's probably it has some advantages to have your own employees offshore, particularly in terms of training, culture, HSE, and you name it. But at the same time, this industry is so cyclical, so you cannot go 100% own employees. You want to hedge yourself a little bit by having some percentage of your workforce has got to be contractors. I don't think it's going to change a lot over the next 3 to 5 years, but it's something we're evaluating quite regularly.
Thank you, Kristian. I have another question here from Hartwig von Hartmann asking, what do you think about activities regarding exploration for geothermal energy? Have you seen anything like that as yet?
We've seen a little bit. I still think we're very early days in that regard. I mean, there's no question that you need subsurface data also for geothermal. But I think the subsurface data we provide is quite expensive, and it's quite high end. So you would typically use that data if you build like these big power parks based on geothermal, rather than, we wouldn't provide subsurface data to a private house, right, or a residential. But I think there is an opportunity for sure, but I still think we're very early days and we haven't seen huge demand yet.
Fair enough, I suppose. There's a question here from Elizabeth Branyi asking, in your opinion, how quickly would the big players pivot back to exploration mode? Would it be fast enough to avoid a crisis in supply, I guess they're getting at?
Yeah, I mean, eventually they would do it if there is a crisis, for sure. But I think what needs to happen for these, especially IOCs, to get back to exploration or increase their exploration budgets substantially would be some push from Wall Street. So basically push from their shareholders that, hey, I've invested in your stock because I get the dividend, but now I see I can only get that dividend for 5 more years because after that you're not able to produce the same amount and generate the same cash flow. So I think there will eventually be a push from owners that you need to change your strategy and go back to a growth strategy, or at least move yourself on that axis. So again, I don't think it's necessarily going to happen. We're not going to have a crisis in a year or two, but we may have, or we may see the start of a crisis in year 3 to 5. And that's where you're probably going to see some of that.
Fair enough. Yeah, I guess the power lies with the shareholders or the owners. There's a question from John Paul Brennan here asking, where do you expect exploration as a percentage of total spending to go in the next 3 years?
Yeah, it's interesting because that number, you know, when I started in this industry back in 2010, we used to say that it was 20% exploration and 80% production. And of the 20% exploration, it was 80% drilling and 20% seismic or data. That used to be kind of the rule of thumb. What we've seen in the past couple of years is that the 80-20 exploration versus production is now probably 90% production and 10% exploration. And then on top of that, we've seen that the 10% that is left for exploration is probably 90% drilling and 10% data, which means that we're kind of losing out on both those equations. That will definitely change. And I think that 2025 and even 26, you may see that we will get a higher percentage of the exploration budgets because there's been an intense focus on drilling in the past couple of years. And that may change in a favorable way for the seismic industry. And then is it going to change the 90-10 on production versus exploration? That's still going to take a bit of time, I think.
Excellent, thank you. I have a question here from Liana Gonçalves Ferreira asking, do you think the prices of the new acquisition technologies, for example, OBN, will remain stable considering that exploration in mature areas is becoming more and more attractive?
It's interesting because our clients are pushing very hard for more efficiency and cheaper OBN data. At the same time, if you look at the different players who are acquiring OBN data, they're not making any money, right? So it's a tough one. But of course, we need to continue to invest in new technologies, whether it's on the source side, on the ROV side, and even on the node side. So there's basically 3 components to this. And we as an industry will always have to strive to get better, but it's not an easy one. And I think our clients will have to realize that this is not a very efficient way to acquire seismic. It's far more efficient to tow 16 streamers behind a vessel. So in order to get that data improvement or the improvement in data quality, you probably have to pay up. And then I think the secret sauce here is obviously the combination, you know, where we do sparse nodes, where you do a combination of underlying streamer data and we stitch it together with sparse node data. And that's the most efficient way you can do it, of course. If you could do OBN in big areas, you would definitely do it, but it's too expensive. And then you have to kind of find that optimal balance of using underlying data and together with new OBN data. And the question is, how sparse can you go? That's really going to be the secret sauce.
Thank you. There's a question from S. Karthik asking, what do you see as the role played by developing countries? I know you mentioned Brazil earlier, but this question is more specifically about India in terms of new prospectivity and their renewable energy sector.
So India today has about 85% import of energy. So their energy needs that are growing massively year over year is sourced by 85% imports. And obviously that's not a sustainable way to go going forward. So there is a substantial push on India in terms of finding oil and obviously produce oil domestically. So we've seen a lot of the big super majors go into India, partnering with the local players. We see a government that is far more supportive to exploration and oil and gas, and as a result, you see quite a lot of geophysical activity in India now. So yeah, definitely one of the countries where we see growth, and we see the same in pretty much any country where you have the combination of high population growth, and a high percentage of import. You will see that push. Indonesia, Malaysia, India, Bangladesh, you name it.
Yeah, fair enough. I hope you can bear with us a little bit longer, Kristian, because your talk has generated a lot of interesting questions. So I'll keep hammering on them if I may. We have a question here from Jan Vixie asking, how many deep sea nodes are currently on the market, and what do you think the future demand will be for that technology?
Yeah, I think I had a slide on that. I think it's just above 170,000 ocean bottom nodes in the market right now. There are still nodes being built, but again, we as an industry shouldn't fall into that trap that we've done many, many times, where we just continue to build, and then until there is no demand, and then everything collapses. So at TGS, we're very focused on that, and we make sure that, yes, we have about 35,000 nodes today. We don't plan to increase that number. We rather focus on getting more efficient in terms of ROV source and develop the nodes that we already have.
Yeah, I guess you need to be cautious there and forecasting what you need for the future. We have the next question from Mike Kogan asking, or thanking you first for a great context presentation, and asking if the energy transition is pulling E&P companies towards a lower margin business, and what do you think would have to change on the E&P side to get companies to be less focused on shareholder return, but still be an attractive investment? Higher oil prices, increased efficiency, maybe from something like AI, or... That's a bit of a compound question. Sorry about that.
Yeah, no, it's a good question, and I think if you look at the E&Ps today, I mean, some, and particularly the European ones, they invest in renewables, they invest in offshore wind. Take Equinor as an example, Total, BP, Shell to a certain degree. While the Americans tend to focus on CCS. Exxon is a great example of that. So without having too much detail about that, what you can read from that is that the Americans are basically making the bet that you will need oil and gas in decades to come. So now it's all about, how do I make sure I get a license to operate in 3 decades from now? While the Europeans have taken the stance until recently that, hey, there may not be a need for oil and gas in 3 decades, so let's make sure we get prepared and we invest in renewables. And you've seen a bit of a change in the last probably 12 months. You've seen BP is kind of making a slight change to their strategy. You've seen Shell, Total probably lower investments in renewables, or at least keeping them flat. And as a result, you see probably a higher focus on oil and gas. I mean, we shouldn't forget the fact that we were sitting here in June 2021, and IEA came out with a report saying that there is no new exploration needed. Probably one of the toughest days of my life when I read that report, but fortunately it wasn't right. And I think we all realized that was not.
Yeah, that was rather depressing for me too, I thought, but happily it didn't quite pan out that way. We have a question from Miggy Primato asking, do you think there will be consolidation in the OBN markets, same as the streamer market back in 2013 to 2015?
Yeah, I definitely think so. I think a lot of new entrants are trying to get into that market, and it's not an easy market to play. We've seen that. We took over Magseis back in 2022, and both Magseis and Fairfield had a history of some really big losses, and if you don't have the equity and the balance sheet to carry through some of these losses, then you may be a target for sure. So yeah, I think with any industry, you will see over time that it will mature and you will have a few bigger players rather than a number of smaller players.
Excellent. Thank you very much, Kristian. There's still some more questions, but I do believe we're just about out of time. And before we get to the top of the hour, I'd like to thank you again from the Regional Advisory Committee for Europe for the SEG, and thank all of the participants for their excellent questions and their time. And I hope you're all looking forward to the next State of the Industry webinar that we're planning on very soon. Please join me in one final thank you for Kristian and Laurie for helping to facilitate and organize these webinars. Thank you.
Thanks, Anthony. Thanks, Laurie. And thank you to everyone for the attention today and some really good questions and great engagement. So thank you very much and have a great day.
Yes, have a good day.
Thank you.